This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jim back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jim's picture saying, looking for the downloads. Okay, Eric, what are your thoughts here on the equity markets?
The S&P 500 has been consolidating since mid-December, almost 2 full months now. We're still above most of the moving averages, but the 100-day moving average, which has supported this market for well over a year, save for a brief 3-day dip below it last August, is fast approaching. More and more pundits are expressing the view that retail traders are the only people still buying, and that the market is headed for a downside reversal. But for now, we're still above all the major moving averages.
Eric, I have to agree with your assessment. I want to look deeper into this, though. On page 2, we have that chart of the S&P 500. You can clearly see that trade range. What needs to be considered is that the Mag 7, which are huge in these market cap weighted indices, are almost all struggling beyond, let's say, Meta. And this trend, if it continues, is going to be a drag that is going to really not allow the S&P to make any meaningful progress. When you then go look at the broader market, such as, let's say, the Russell 2000 small caps, they fail to in any meaningful way rally and have already rolled over. And when you look at even the broader market in terms of the breadth, we still only have 50% of stocks above their 50-day moving averages on the S&P 500. So we have a market that lacks breadth and Mag 7 participation, and small caps are not contributing. So you have an issue of flows. This makes the market very tired and heavy here. Now, if you want to be bullish, that would mean that you have to believe that this oversold state of the mags and the fact that the market breadth has not been there will all return and drive that next impulse. I'm sort of a wait and see perspective, which is I'd want to see that developing for me to take a bullish stance. Otherwise, a very tired and heavy market like this has increasing risk of correcting, and therefore I'm watching to see whether breakdowns of the 5950 to 6,000 level on the S&P futures breaks down, which would really, in my mind, be the first signal that some sort of bigger corrective phase is underway. Now, Eric, let's move on to the dollar. What are your thoughts here?
No change from last week, Patrick. We're still trading sideways in a consolidation pattern. A sustained move above 110 or below 107 on the Dixie would be the tell for the next directional move.
Yeah, after hitting 110, we've been in consolidation. The consolidations held the 50-day moving averages. But overall, other than a very strong yen move, which is now reverted, almost all major cross currencies, whether the euro, the pound sterling, the Aussie dollar, and even the Canadian dollar, all continue to be structurally weak and distributive in nature. So unless we see certain currency pairings start to show some meaningful strength that could lead to a bigger, deeper U.S. dollar correction, I would want to approach this that the dollar primary bull trend is still intact. And if this consolidation in any way finishes playing out this way, you would expect that the next move is still for dollar bull continuation on the upside. All right, Eric, let's touch on oil.
Well, Patrick, after a brief upside reaction to the Gaza policy-related geopolitical risks, we're back down to cycle lows along clustered moving averages right around $71 WTI. The 100-day moving average at 70.11 on WTI is the big line in the sand, and if that doesn't hold, there's not a lot of obvious support below it until the low 60s. It's still hard to make a directional call here with any conviction because the news flow is changing by the hour, particularly with uncertainty around what Trump is going to do next on Gaza-related policy. Follow Dr. Anas Al-Haji on Twitter, that's at Anas Al-Haji, who's been giving excellent updates on the Middle East geopolitical situation as it pertains to the crude oil market.
Well, Eric, on page 4, I have that crude oil chart. And one of the things that we were trying to determine is whether or not the rally in crude oil was just a short squeeze because there were too many shorts in the market, or whether it was a meaningful bull turn. And the way that I always framed it was the fact that it would be all about the way the bulls behave during an oil pullback that would be the tell. And so as oil pulled back toward its moving averages and toward Fibonacci zones, if it was in fact a new bull phase in oil, we should have seen the buy-on dips come in relatively quickly and the crude oil get back quickly to that $75 to $77 range to really signify a new accumulation cycle. Instead, we've fallen right back into the trade range that was established in the fourth quarter of last year. That doesn't mean that there's a big downside move on oil, but we're sort of stuck in this trade range purgatory again, and that means that the entire next major move in oil might be pushed into the second quarter of the year. Whichever way you want to frame it, at this point, oil is very quiet, and there's a lot of other markets that are moving in this environment. All right, Eric, on page 5, I have that chart of gold. What are your thoughts on this big ripping rally?
Gold has been an easy call until now, and it's been a great ride for all of us on the long side of that trade. But on Tuesday, we put in a perfect test of both R1 resistance at 29.63 and channel resistance, which was co-located just above it at 29.65. That level was rejected hard to the downside on Tuesday, putting in a shooting star candle suggesting that the rally might be ending, at least in the short term. So a technical argument can definitely be made that Tuesday's high could be at least a short to intermediate term top. And with channel support now co-located with the 100-day moving average just above 2,700, a $250 correction from here wouldn't be at all out of place and wouldn't violate the long-term uptrend. All these factors should have caused technical traders to take profits and brace for a downside correction. But the market had held up surprisingly well as of Wednesday's close, and in early trading on the Thursday overnight session, it was holding up remarkably well, looking like it wants to rally back up towards those same highs that it tested on Tuesday. And the reason that that might be happening could very well relate to the Mar-a-Lago Accord that Jim Bianco described in today's feature interview. Now, remember, the strongest fundamental driver for gold is real interest rates, because gold competes with treasuries. Both are considered ultra-safe assets, and the more treasuries yield in real terms, the more attractive they are compared to gold. And what really causes gold to soar is when real interest rates go negative as treasury yields fall below the rate of inflation. Normally, we analyze this in terms of marketable treasury yields. In other words, if I chose gold as my safe haven asset rather than buying treasuries on the open market, well, how much yield would I be giving up by choosing gold, which has no counterparty, over treasuries, which pay a yield? But if the hypothetical scenario that Jim described in today's interview actually came true, well then, at least for central banks, which are the biggest buyers of safe haven assets, they'd be choosing between zero-yielding gold and zero-yielding treasury paper, and gold would be the obvious choice. But the flip side of that coin is that any favor that might tend to give to gold would be usurped by the fact that the U.S. would presumably demand that foreign central banks hold a certain percentage of their GDP in those new zero-yielding treasury bonds, or else face loss of military defense protection. So they would presumably forego gold in favor of getting that military support, but only to the extent that they were forced to. If I put myself in the shoes of a foreign central banker, if I thought any of this stuff were really and truly actually about to happen, well, I'd rather enter that negotiation with a larger gold position and a smaller treasury position, just in case current holdings came into the equation for how much each nation would have to be required to invest in these new zero-yielding Zoltan bonds, or whatever we're going to be calling them. So, bottom line, the technicals say that this gold rally is long in the tooth and should be ending here. Either the top is already in, or we'll get a test of round number resistance at 3,000 before reversing downward and eventually retesting that bottom channel support line, which is down around 2,700 right now. But if this market breaks out with momentum above 3,000, that would say to me that central bankers see the Mar-a-Lago Accords on the horizon and are positioning for a whole new monetary negotiation with the United States. If that actually happened, we could easily see $4,000 gold in the next few months. But that's only if the scenario that Jim laid out actually became policy, as opposed to just a speculation of what they might be thinking about.
Well, Eric, on the short term, that 3,000 is definitely the upside target for this move. But overall, there is the case for a very bullish gold going into the end of the year and into next year. There's all sorts of big upside targets you can have. But I want to look at it purely from a technical perspective on the very short term, which is as we approach 3,000, typically the first test of these kind of areas would offer resistance, which is that would have some sort of consolidation or pullbacks. So I look at it here that gold is in a primary bull market that is very clearly being bought on dip on almost every pullback. So therefore, you have to respect that the bulls are definitively in control. But at some stage, there will be enough resistance where gold will once again consolidate. And it might pause for a month or two like we've seen in the past along those levels. If that price action remains generally accumulative in that consolidation phase, that would be the springboard from which to launch a much more bullish move, maybe into the second half of the year. I think on the short term, we're going to start reaching some resistance levels, but that doesn't make it bearish by any means. All right, Eric, let's touch on uranium.
Well, we had another week of overwhelmingly bullish nuclear news flow, ranging from Justin Trudeau endorsing large-scale nuclear to several comments from U.S. Energy Secretary Chris Wright talking up the nuclear renaissance. Yet still, in the face of all that, the price of uranium and uranium miners is dragging along at cycle lows. So I'm going to spend a little bit longer than usual on uranium this week to see if we can get to the bottom of what the problem is and also to propose a solution of my own design for what I think the problem is. I got a lot of feedback on X and in private emails and DMs from last week's episode with Guy Keller and my comments in that episode in the postgame segment when I said that I was on the hunt for a good explanation for why spot uranium prices have diverged from enriched uranium prices and why that's persisted since early 2024. Nick Lawson over at Ocean Wall was kind enough to publish a new chart in reaction to our episode last week, and you'll find that chart in this week's postgame chart deck. I want to thank Nick for supporting us with this chart, and I definitely recommend @OceanWall2 as a must-follow on X for anyone who's interested in the uranium market. As you can see from Nick's chart, the real story on uranium prices is being told in private by the term contracting market shown in orange, which continued to move higher in a consistent uptrend all year long throughout 2024. The only thing that was down in 2024 was the spot uranium market, shown in blue, which Guy Keller described as the most dysfunctional commodity market he's ever encountered in his entire career. Cameco's CFO Grant Isaac made similar comments in another podcast interview last week, reiterating our friend Justin Hune's view that the spot market, as shown in blue on Nick's chart, has so little volume that it basically doesn't even matter and isn't relevant, and that the term price, shown in orange, is the only one that we should even bother paying attention to. Well, that's all fine and well, but the problem is the orange term price is only reported once a month, and even then, you need a paid subscription to UXC or another uranium market data provider in order to even know what's going on with the term price. The only price the investing public sees is the spot price of uranium as shown in blue on Nick's chart, which isn't a meaningful indication of what's really going on in the term market, which is where all the volume is. So it's easy to jump to the conclusion, well, okay, this could only mean that there must be some evil conspiracy among the fuel buyers to manipulate the spot price lower in order to break the spirit of uranium bulls. Yeah, it's tempting to say that. There's actually several other plausible explanations, and quite frankly, I don't think the fuel buyers are that sophisticated. But I do think this market is very badly broken because of a lack of transparent market data to the market that actually matters, which is the term pricing market. So I'm going to propose a solution in hopes that our audience can make it happen by talking this problem up on X and elsewhere until someone takes action to fix it. Cameco and the other big producers obviously have a vested interest in having an orderly market that pays them full price for their product. So I'm going to argue that it's very strongly in their interest to make the term price data public somehow. A big producer like Cameco could just start their own price index based on their own term contracts and make it free to the public so that everybody sees those term prices. Or they could cut a deal with a uranium market data provider like UxC to subsidize the cost of UxC taking what's now proprietary data, changing their policy, and instead giving it away for free for the sake of creating a more transparent uranium market. Now, obviously, UxC deserves to be compensated for their work, and I don't mean to suggest that they should become a charity. My point is simply that the producers who sell uranium for a living would all benefit immensely from more transparency of the pricing in this market. And they could accomplish that by subsidizing USC, providing them with funding in order to make what is now a proprietary data series public. All we have that's publicly visible for now is the official spot price, and as Nick's chart so beautifully illustrates, it's actually a source of misinformation about the real price of uranium, and it seems clear that that misinformation is probably what's stopping the bullish fundamental news flow from translating into inflows into the stocks of those producing companies. It's very much in those companies' interest to fix this problem, even if it costs them a few bucks to do so. Somebody needs to fix this broken market. I think the solution is to make the term price data public, and ideally publish it more than just once a month. The stakeholders with a vested interest in being paid full price for their uranium need to figure out how to make that happen.
Well, Eric, broken market or not, observing simply the price action that we continue to see in uranium, it is distributed. And on the short term, we do see a pattern of selling as whoever was holding the yellow cake is certainly hitting the bid. At some point, obviously, that divergence will reconverge, and maybe it's a big opportunity. But on the short term, this is a market that's not attracting any capital, and it's a very quiet market, and will be interesting to see when that transitions into a new accumulation cycle. Though finally, Eric, I wanted to just touch on that chart on page 7, which is that Euro Stock 50 index. And while many people are seeing this distribution in some of these Mag 7s and in the S&P 500 and small caps, and wondering where the sector rotation would go, as in that there are other areas that would take it, but it looks and feels far more like a rotation globally, particularly as money is finding the European stock markets at a cheaper currency and better valuations. And so the Euro Stock 50 has been ripping like it's a new bull market, and certainly continues to gain more and more traction on the upside. It'll be interesting to see whether or not we can see a big global equity divergence like this continue, where, for instance, the U.S. equity markets go through some sort of correction, and the net benefactor from flows actually could be that the continuation of the European stock markets rising in that light. That's certainly a trend that I want to continue to observe, whether that continues.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.